I will start with an introduction to myself. I think some of you probably might have read the brief, but otherwise, let me introduce myself. I'll share my screen with you. Are you doing a recording now, Daniel?
Yes.
Okay, just for me to, and then I'm going to share my screen.
Yeah.
Okay.
I made you a host, Joyce, so it should be easy.
Okay, that's great. Yes, so here I am. Okay, can you see my screen?
Yes.
Just at least a few, like somebody says yes, then I think we're good. So what I'm gonna do is, and I think, let me just narrow this down. All right, so what I will cover today is the 5 wealth hacks that, well, you should know after COVID-19. It's not just after COVID, it's also probably before COVID and during COVID. It's just, I think if I put in after COVID, it sounds like there is a lot of things that you could work on and improve, you know. So if you want to get a hold of me, my email address is also given to you. It's right here. I'll make the slides available probably to Daniel on a closed basis. And then we can move on from there. Oh no, I hope my internet's gonna be okay. All right, so as a start, maybe a little bit about what I do. So I am actually a visiting professor in many European universities as well as American universities. And I teach corporate finance and valuation. So very much on finance, that's my area of specialization. Before I came to Budapest, this is where I'm based right now in Budapest. I was actually, I'm originally from Singapore. So I've worked in Singapore. I've worked for the Singapore government as well as various entities in Singapore. So quasi-government as well as the government. So I've worked in the tax authority in Singapore. I've worked for the International Enterprise Singapore, which is like a trade arm. And then of course the Ministry of Trade and Industry in Singapore. And I think you all know that, well, Singapore is probably renowned for international trade. So that was what I did for a number of years. And then I came to Europe and I worked as a regional controller for KPMG in Central Eastern Europe, and I was based in Budapest. In terms of my studies, I did my first degree in Singapore in business. And then I did my master's in finance in Australia, and that's the picture that you have right here. So what I do apart from teaching and training is I do collaborate with small, medium-sized enterprises. So entrepreneurs, for example, small businesses. And what I help them do is identify what drives the value. All right, so just a context, yeah. So I thought I extracted I'll extract something from IMF, which sort of gives us a perspective of what is the world economic outlook like. And, you know, they kind of term it as the Great Lockdown because that really was what we experienced all around the world. And the pandemic, right, I think you all realize right now that it actually has impacted economic activity. Maybe not specific, you could be in a lucky industry that you're not quite affected by it directly, but indirectly you will be. Yeah, it's just a question of how badly affected you are. So as a result of the pandemic, maybe a little bit of the statistics. Yeah, so I have here, this was extracted just, well, yesterday that I did it, but it's a very updated outlook, yeah. So it's April 2020, and it sort of takes into consideration or account the COVID-19 pandemic. And you can see the world. And you've got US, Euro, and the Euro area. You've got the Middle East and Central Asia, developing Asia, and emerging Asia, and then you've got Latin America and Sub-Saharan Africa. So you kind of look at the global outlook, and depending on the regions of the world, it's impacted slightly differently. So on the worldwide basis, maybe just to explain this, so 2019, the average real GDP growth, yeah, so for the entire year was about, it's not confirmed yet, so it's about 2.9%, that was the estimate. And the projections for 2020 is a negative 3%. So you're not even positive, you're negative, and you're negative 3%. And that's actually worse than the financial crisis. Yeah. So it sort of gives you a perspective. I think we all have lived through the financial crisis. Maybe it's not impacted us so much, or maybe the impact was delayed. Yeah, I think in Europe it's slightly delayed. Definitely in Hungary it was. You don't feel the impact in 2008, 2009, but definitely in the 3 years ensuing after the financial crisis. And I think that's the worry we have here in Europe as well, that it takes a while before you see the impact on your business and on the economy. So in the euro area, it's even worse if you're going to take a look at the numbers. In fact, if you compare across the regions of the world, Europe is going to suffer the most. And sadly enough, we are living in Europe and probably doing business in Europe. So you're looking at negative 7.5% in 2020. And then, of course, back up. Of course, if you come from a very low base, you can always go up here. And it's actually a nice resurgence in 2021. Of course, these are projections. It could even be worse than negative 7.5. And if you're looking at which region of the world might recover first and more, then probably Asia is definitely the place to put your money in the long term, because that's usually the place where you see the greatest resurgence and growth. Yeah, so I think that sort of gives you a perspective of what is going to come up in the next couple of years or next couple of months, 2 years. And so what do we foresee? So I think there are a few things, probably rising unemployment. I think you see that already in the US. You turn on CNN and all you hear is the bad news, one after another. In addition to that, you've got falling incomes. I think incomes around the world will fall as a result. I mean, if you don't get retrenched, then they're probably going to cut your bonuses, cut your income, somehow move you on to, instead of working full-time, you work part-time, so incomes around the world is generally going to fall. And because income falls, what we tend to see in economics is that property prices tend to fall because there is just a lot less demand for real estate. People are less likely to buy a new property when you know that you're so uncertain. I mean, when you're so uncertain about what the future will be like. And falling demand, I think that's also something that we see definitely in certain industries. The airline industry is very, very badly affected, and I think the hospitality industry as well. The question is, will the demand come back to the levels that we have seen in 2018, 2019 is really something that a lot of analysts do not project. So it's going to take a number of years. Yeah. So they're estimating that the airline industry will take at least 3 years to get back to the levels that it had in 2018. So it could even take longer because it depends on how comfortable we are with traveling in general and all the hassles that that it comes with traveling. Yeah, so that's and also I think when it comes to corporate travel, I think that's going to be a cut for sure over the years in time to come, because everyone now realizes that, hey, it's much easier just to hold meetings virtually. You don't really need to travel to see your supplier, to see your customer. You could do it online, because this is what we've been doing the last 3 months. So demand is going to fall in various areas. Yeah. And because of that, we're going to see corporate bankruptcies. I think increasingly, I think you're going to see a lot more bankruptcies around the world. Interest rates are falling because the economy is falling. So it's not a very exciting picture that I'm painting, but this is reality for us. Yeah, interest rates are falling simply because governments have to kickstart the economy and they keep interest rates very low. And I think you are feeling it right now as well. Wherever you are in the world, probably in Romania, I think your base rates have fallen. The base rate for the euro has definitely fallen, and in fact, in many circumstances, is actually negative. Yeah, so your falling interest rates, which also has an impact on what you can do with your money. Government debts are rising. I think governments are trying to bail out. The US is a classic example, and I think you see that in Europe as well. And as a result of it, what you will notice is currencies will depreciate over time, and you just have to deal with the depreciation of currencies as a result of rising government debt. I have a request. I think somebody's microphone is turned on. Yeah, if you can just double check, just to turn it off, so that we don't get the interruption at the background. And the last one is disrupting how businesses currently operate. I think this is a very big issue that we are all facing, rethinking of how we're doing our business until we have a vaccine for COVID-19. Of course, people are very optimistic and saying, I mean, there's a lot of say that the vaccine will, that a vaccine will be found in this year. I don't think that will happen. Next year, if you're lucky, but I think it's going to take a while. Yeah, so we'll just have to live with it, and which means businesses have to re-strategize and probably reorganize the way they operate. Yeah, so the question is not whether all these will happen, but when it will happen, and how long will it last. I think that's the whole idea. Yeah, so some economies are more susceptible than others, and some governments are not as effective as others, and so we are kind of living in this new reality. And it's unprecedented, which also means that when it comes to personal finance and your personal wealth, you got to think of ideas like, what can you do with what you have at the moment? All right, so that's the context, and I'll move you on to the 5 hacks. Yeah, so I've decided to narrow it down to 5 because I think if I have like 10, no one will remember all the 10. But if it's 5, it's kind of easy to remember. And the first wealth hack is, I think, given all that's happening, it's always good to diversify your income streams. So if you only have one income stream, you're very, very dependent on that income stream, and that sort of puts you on very, very high risk. Yeah. So you could think of ways of how can we diversify our income stream. So I'll give you an idea. I mean, this is not my extract, but it's something that I've taken out from the internet, which I thought was kind of useful as a perspective. Yeah, I think all of us have earned income. So the income from working on a job. So I think all of us have a job, so we earn some money. There is also the profit income. So if you run a business, then of course we're talking about the buying, the selling. So you make profits from your business. So it's slightly different from the salaries that you get. So the number 1 is salaries. Number 2, it's more like a profit. So as an entrepreneur, for example, you might earn profits as well from your business. Of course, you can tell me I don't pay out all my profits, which then brings us to number 5. But let me move on. Interest income. So if you lend money, I mean, it can be lending money to a friend or a business, or you can, of course, lend money to a bank, which is essentially put your money in deposits in the bank, and what you get is interest income. Only problem right now is number 3 is kind of out because interest rates are so low. I think you get peanuts in interest income. I think if you do get anything very attractive, it's highly likely that the bank is on the verge of collapse. So you always have to weigh that in and realize that interest income is very, very subject. It's subject to economic climates. Yeah. So when times are very good, you can earn lots of money from interest income. When times are bad, then this is probably one stream that you should not really bank upon. Residual income is when you continue to get paid. So as an example is you publish something. I mean, you've got a YouTube page, and you get. So as an example, yeah, you have a YouTube page and you create videos, and every time the videos watch, you get an income from the advertisements. So that's residual. Yeah, you just sit back and you get paid. Residual is to some extent like passive income. So you only do the work once, and thereafter you sit back, and as long as somebody watches your videos, there is always the stream of some money that keep coming in, and you go ding, 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 and that's your money coming in into your pocket. Dividend income, I think you can relate to this. So it can come from your business, or it can come from a business that you invest in. So if you're investing in the stock market, for example, which is what I do extensively, you buy Apple shares, not Apple products, but you buy the shares. The shares gives me a regular source of dividends. Yeah, so it's nice. You can, collect those dividends, and then you've got rental income. I think needs no explanation. Capital gains is where your assets increase in value. I think for you, what you probably can relate to is your property, which is basically the biggest asset that you have, apart from your business maybe, but your property. Yeah? And if your property increases in value, then we talk about capital gains as an income. The only thing is it's not a regular source of income because you can't keep buying and selling properties, but you know that, well, on paper, you have this gain and it feels comfortable. It feels quite nice to you. And then the royalty income. Royalty income is when someone uses your idea. Yeah, so you patent an idea. For me, as an example, what I do is I write for a test bank in the US. I have a few hundred test questions in finance, and these are for professional exams. And every time someone accesses my questions, I get paid a royalty income, yeah, because it's the royalty that I mean, yeah, it's what I provide. It's my knowledge, and I receive that. So I think the idea is, and out of these 8 streams, I think you should tick it off and say, you know, which ones do you have, which ones do you not? And the more you diversify, I think the whole idea is the better it is, because it sort of reduces your over-reliance on just one particular stream, which is never the very best. Even in the best of times, it's never the best. Yeah, because you never know what will happen. So that's the wealth hack 1. Think about diversifying your income streams. Think about the different streams that you can tap on. The second wealth hack is look for passive income. It sort of ties in with the residual income. So passive income is, I have a nice quote, and I think to get rich, you have to make money while you're asleep. So if you're sleeping and chilling and, you know, taking it easy, passive income means you don't have to work for it, for the extra $1, the incremental $1 that you're earning in your pocket. Yeah, you've done all the work already. So what you do is you sit back and now you're just looking at passive income. So some of these streams of income is actually passive. I mean, if you think about it, dividend income, if you invest in the stock market, it's actually passive income. Rental income to some extent as well, except that I think with rental income, if you rent out a property or you rent out a property, you realize that you do have to put in some effort. It's not as easy as a dividend income from the stock market, or it's not as easy as royalty income. So there are different levels of effort that is required to achieve that passive income. So what we want is a passive income that is really passive, that you don't have to put in so much work, and it doesn't cost you a lot, yeah, because property, for example, you have to maintain the property. That will cost you some money. You need an agent. You got to deal with painful tenants. You got to deal with repairs. For me, that's a big hassle. Living through the experience myself, being in Hungary and having properties in Singapore, rental income is not always the best source of income. Yeah, I think there are other easier passive sources. So on the spectrum of passive income, there is one that is very, very passive, and there is one that is slightly less passive. So I think you have to think about how we can create passive income where you don't need to work for every dollar that you put on the table. The third wealth hack is coming along. So once you get all your income streams organized, the idea is, how can you make your money work harder for you? Yeah, so the idea now is relook at your current investments. I think most of you have investments, probably with a fund. So you put your money in the bank, and what usually happens is the bank will call you, and the bank will ask you, oh, would you want to invest this source of money that you have? And you go, okay, sure, it's not very much effort, let me just invest. So the question then is, how have they been performing? Yeah, so have they been doing well? I mean, relative to a benchmark. So I'll give you an idea of what is a benchmark later on, but how have they been performing? I think it's time to relook, because you want to make what you have work harder for you. So not just what are new sources of income that you can get, but what you have has to work harder for you. So are you satisfied with the returns on your current investments? What are your management fees? So if you buy into a fund that is sold by your insurance agent or by your fund or your banker, you have to pay a fee. And have you wondered what that fee was and how much it costs you? And then the next question is, can you even think about investing on your own? Yeah. So is it as daunting as it appears, or maybe it's actually not so difficult? So what are the options available for you? All right, so that brings us to this one here. Yeah, I just want to show you something. This was extracted from the latest S&P Dow Jones indices. Yeah, what S&P does is they they analyze funds around the world. And this was about 10,000 actively managed funds. So by default, if somebody sells a fund to you, that is an actively managed fund because, well, you've got the guy who sells it to you who's earning money and the guy who is running the fund that's earning money. So this is what we call an actively managed fund because you've got a fund manager running the fund and you've got agents selling the fund. Yeah. So when we analyze about 10,000, when they analyze 10,000 actively managed funds around the world, this is just for Europe because since we're in Europe, I thought I should bring you the European example and the European evidence. Yeah, these are the percentage of European equity funds that outperform by the benchmark. So what it means is, if I compare any European equity fund in Europe against against a benchmark. So a benchmark is like an index. Yeah. So we say, I'll give you the easiest example, the US equity. So if you buy into a US equity fund, the benchmark that we use is the index in the US, and that's the S&P 500. What this means is if you look at it on the 10-year basis, so if you're looking at investing in the long term, which is about a 10-year time horizon, and we go all the way to the end, it says here 98.21% of European equity funds are outperformed by the benchmark. So what this means is almost all equity funds in Europe, so about 98%, yeah, are actually doing worse than the benchmark. Yeah, so the benchmark is actually better. So forget about actively managed funds. So if your fund manager or insurance agent tries to sell you something, I think the first thing you'll say is just forget it, yeah? Because you cannot beat a benchmark because the empirical evidence is such that we notice across time, so we were looking at it on a historical basis, not a single actively managed fund. I mean, you're looking at very, very high percentages here. So about 90% of actively managed funds do not outperform the benchmark. Yeah, which means you really don't need to buy into anything they tell you. More often than not, it's just not going to make your money work harder for you than just buying the benchmark. So this is, I think, good evidence that maybe at the end of the day, when you are looking at reevaluating your current investments that are tied up in the banks, a lot of them, you really should sell it because you're not going to make money in the long run and you're better off just buying the benchmark. And you definitely can do that, even at the ease. I mean, yeah, in front of your computer in Romania, doesn't matter where you are in the world, you can buy into the US benchmark on your own. So why would you want to get a return that is even lower than the benchmark on a historical basis? Yeah. So I think on the 1-year basis, I think there are some that do better. I mean, but still, I think the numbers are all above 50%, which means by default, most funds do not beat the benchmark either on a 1-year, 3-year, 5-year, or 10-year time dimension. All right, so that's, I hope, revealing evidence for most of us that you really can invest the money on your own without having to deal with fund managers and bankers and insurance agents. Wealth hack number 4 is, I think everyone should build up the equity portfolio. So it's good to have your money in your company, but remember, you're not diversifying your risk because you need to get streams of income from different baskets, yeah, or different, what we call blocks. And if you have a portfolio right here, then what you are looking for is money that is invested in the equities, yeah. So if you have still 20 years to retirement, it doesn't even have to be 20, it could be 10, for example. You have excess money. You do not require these money for the next, 5 to 10 years, and you're comfortable. There's always some risk as well. So are you comfortable losing 10 to 20% of your portfolio in a year? Because on an average, the market will improve. And I mean, I think it's a good example right now that what you see is the markets have actually moved up so much relative to the real economy. So there is a slight divergence between stock market performance and economic performance, and everyone's questioning why, and there is a basis for it. Yeah, because stock markets look at future cash flows and future growth, and current economic information do not reveal the future. So are you comfortable losing, a little bit of your portfolio each year, but on an average still make money in the long term? Or are you saving for the next generation? Yeah. So if you can't be a millionaire, you can make your child a millionaire for sure. And it all starts with doing the right things at the right time and doing it early. Yeah. So if that's all that you are thinking of, then yeah, maybe it makes sense to build up your equity portfolio to have at least some money that is tied up in the stock market, because you grow with the growth of these companies. Yeah. So I think I have here, sorry, I just realized I've got Google, Microsoft, Johnson & Johnson. So some of the companies that we all can relate to, and we know them. So let me tell you why it makes sense for you to invest in the stock market. The first thing is the stock returns have surpassed all returns on all asset classes in the long term. So there is no other asset class apart from your business, which is a bit different. So there is no other asset class that you can think of. So whether it's real estate, whether it's bonds, whether it's stock market, so you're comparing stock markets, bonds, you're looking at structured instruments, you're looking at real estate. So there is nothing that beats the stock market in the long term. Yeah. So what this means, I'll give you an example right here. This was the same visual that was in my slides two slides ago. The only difference is also extracted from S&P. The only difference is what I have here is returns rather than which funds do better and which funds don't. This is the S&P 500. Yeah. So in 2019, the return was about 34% in that 1 year. So last year was a fantastic year. So if we met last year and you invested in the stock market at the end of the year, you'd be telling me, oh my God, Joy, I just made a whopping 34% returns. This is also in euros, yeah. So it's all converted into euros, which means you also gain the upside of currency appreciation, because the US dollar has appreciated quite a bit in 2019. So on a 3-year basis, I mean, last year was a fantastic year, but I mean, in investing, we don't look at 1 year, because 1 year could be a very unusual year. So what we tend to do is we stretch it out over a period of time. So on a 3-year basis, I mean, it's about 12.9%. So can you find another investment out there that will give you, on an annual basis, on over a 10-year time horizon, about 16% returns? So what it means is you sit back, don't do anything, put your money in there in 2010, hold it all the way to 2019. That's a 10-year, I'm counting the 2010 onwards, yeah. So I'm counting a 10-year time dimension or time frame. And every year your returns are growing at a rate of 16.38%. Yeah, it's phenomenal if you think about it. So if you're saving for your retirement or for the next 10 to 20 years, and there are no other classes of assets that will offer you better long-term yields than equities as in the stock market. Yeah, and I make a qualifier because I need to explain to you what do I mean by better. Yeah, so if you think about this, then, you know, I think that's usually the place where people should put their money if you have between, you know, if you're investing for your retirement, or you've got 10 to 20 years time frame and you're willing to wait on the money and you don't need the money immediately. So that brings us to wealth hack number 5. 5 is slightly different from the first 4. So the first 2 was about income. The 3 and 4 is about the stock market, thinking about your investments. Number 5 is really about the debt that you take. Yeah, so I think the whole idea is the ideal scenario for most people on a personal finance basis is to have no debt. For a company, it's different because you want to borrow for various reasons. Tax breaks is one of them. But for a person, I think the idea is you should draw down your debt. So if you're no longer in town, no one's going to take over your debt. Yeah, so that the whole idea is you should draw down your debt, and when you retire, you should have no debt. My question to you is, how much lower can interest rates go? Right now, it's at its lowest. So if you actually had a long-term mortgage, which most people do, you take 15-year mortgage, 20-year mortgage, and if your mortgages are variable rate, then what you realize is when interest rates fall, you are paying less. What you should do is not pay less. If you're comfortable with what you've been paying before, then what you should do is pay the same amount. So I'll give you an example. If you've been paying, let's just say 500 euros every month to the loan that you've taken, and now interest rates have fallen, and now you pay $450 euros instead of 500 euros. What you should do is, if you're comfortable still paying 500, you should maintain it. But the difference that you have, so the savings of 50 euros, should go into your principal. Yeah, you should pay down the principal and shorten the tenor as much as you can. And now is the best time to shorten your tenor, because interest rates are so low. You don't want to be paying for, you know, instead of paying for 15 years, if you can drop it down to 12 years, that would make a big difference. Yeah, that will free up 3 years of your income. Sorry, 3 years of your mortgages, and you can invest that money, or you can spend that money, whatever it may be. But the idea is, the longer your tenor of a loan, the more interest you're paying in the long term. Yeah, and of course, interest rates will rise at some point. And so when interest rates are low, the best thing is always to pay down your principal and to get your loan shortened as much as you can. Yeah, so that's the wealth hack number 5. That sort of brings me to a little bit about what I do, what I can do for you. Yeah, so my question to you is, well, do you have a wealth plan? I think some of you do, some of you are like, what? I've never even thought about a wealth plan. I only think about my business plan. But I think it's always nice to have, you know, that thought, that kind of thinking behind you, because you can't be running a business from now to forever. You run it for a number of years and then you want to get out of it. So you should have a wealth plan. Have you thought about your retirement plan? So wealth plan is the time when you're still working, still having your streams of income. Retirement is when you stop working, and hopefully still get your streams of income. Do you require someone to look at your finances? I do that all the time. I tell my clients, like, oh my God, why do you do this? I think you should just get rid of this. And they do it. They realize, yeah, it makes no sense. Yeah. Sometimes you just need what do you call that? An external pair of eyes to look at something and say, okay, it makes no sense for you to continue with it. You're losing money, or you're not making more. You could make more. So there's an opportunity cost with your money as well, and with your time. The next one is, have your funds provided dismal returns? I've just done a wealth plan for a client last week. And what they realized was, oh my God, they put in so much money into these funds, and they all have given like 1% return. If you think about it over the last 5 to 10 years, which is crazy. I mean, why get 1%? Even the stock market, even the fixed deposit rates, time deposits are more than 1%. And the last question is, does investing sound complicated? It isn't complicated. It's very, very easy. Yeah, so if you can run a business, you can invest for sure. Yeah, so if you need answers to any of these questions, then probably the best thing to do is you can book a consultation session with me. And I could, well, share my insights with you. Yeah. So the whole idea is, I think it all starts with the first step. I think it's taking that leap that makes it the challenge. And once you have taken that leap, I think life becomes a lot easier because it's all mapped out for you. Yeah, so I thought this quote was really cool from this Chinese proverb, that the journey of a thousand miles must always begin with a single step. Yeah, and let's take the first step with me, and I'll show you the path to your financial freedom. All right, so we do a wealth mapping session. So what I do for my clients is, the first half an hour is for me to understand your needs. You share your goals. I can tell you roughly, doesn't make sense, certain things, you should do something else. And then thereafter, so the first half an hour one-to-one session is actually free. I think it's largely for you to be comfortable with me and what I can do for you. Yeah, and then usually we will have a follow-up meeting, and I will present a goal-directed, customized wealth plan. I mean, it's like a blueprint for you to get going, yeah, so that I help you build it so that in time you can improve on it and work on it. So it's not like it's cast in stone. Nothing in investing should be cast in stone. It should be adaptive, yeah, to your life changes. And I think if you've learned how to do it, then it's very easy to work on it on your own. What I offer you, so the first thing is, I'm not a banker nor insurance agent. I am just interested in investing. I've been doing this all my life. So I don't endorse any products. I only want to help you improve your wealth and your finances. And at the end of the day, I have your best interests at heart. Yeah, so that's what I can offer and share with you. I think the easiest way to get in touch with me is via email, and just let me know that we met in this bizz.club Yash platform, and do you want to get started? Then yeah, I can then follow up with you. I have a website that is still under construction, and once that is done, then I think it's a lot easier for anyone to just drop me a message. But the email is probably the best first step that you can take. Yeah, so essentially that's it. At a long-term yields at lower liquidity risk, so you can buy, sell anytime, any day, no problem. Yeah, it's not as easy as trying. I mean, your company might give you a return higher than 16.38%, but remember, you can't sell your company just like that. It takes a while for you to try to sell your company, or even real estate. Yeah, so liquidity means the ability to buy and sell any point in time. It's so easy with the stock market. You don't work, I mean, you have very low price risk, which means the price that you want to sell is a price that you probably will be able to sell. So you don't need to drop your price a lot just to sell it quickly. There is diversification risk. So you buy into 500 companies at one time rather than trying to figure out what's the next Google, what's the next Amazon. I mean, it's not going to be easy, but it's definitely possible. I mean, we can look at creating satellite portfolios, but generally, yeah, if you're looking at just if you have some money and you just want to put all your money into one portfolio, then maybe the S&P 500 makes good sense because you lower your risk. You're cutting across 500 companies all at the same time. And lower denominations. Yeah, what I mean by this is you don't need a lot of money. So to buy a property, for example, you need to put up some money in cash before you can take a loan. And it's not small amounts of money. So even if you start a business, it's not small amounts of money. In the stock market, with $1,000 US, you can get into 500 companies. So I think there are no better investments out there than the stock market in the long term. Have a good day wherever you are. Take care. Yeah, speak soon.